What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. Today, I'm going to talk a little bit about owner financing transactions, do some math around the time value of money, how different payment terms, interest rates, and discount rates affect the actual value that we receive when we're when we're selling a property with owner financing or buying one. I think if you look across a lot of the fractional real estate investing platforms, their owner financing tends to play a big role in real estate investors making deals in today's world, regardless, right? Whether it's to make a property more attractive to sell or to make a deal work a little bit better when you're buying. Um, Really, if you look at the way a lot of investors use owner financing when they're in either direction, they're really just counting on the other side of the transaction, not fully understanding how the time value of money works, not really doing the math around what the deal really looks like. A lot of people get anchored on, I want a certain price for the property. And then beyond that, just sort of play a little bit fast and loose with the terms to the point that sometimes they're getting a terrible deal and they don't realize it. I'm a little bit worried, especially on Lofty when we are selling with owner financing, that we're the a lot of the other owners are very susceptible to being duped by this. Um, I don't think 100% of owner financing deals happen simply because one party doesn't understand, but I think it's the vast majority. The other times are if the tax treatment is different. So, for example, if I want to pay, receiving interest payments are taxed differently than receiving my principal back, and getting my principal in a lump sum might trigger different tax consequences than getting it broken up over time. So there are legitimate reasons like that to structure owner finance deals where you're doing a basically I can't think of an installment sale. Um, that's how it shows up on your taxes. Again, I'm not giving anybody tax advice. You want to check with your own CPA or tax preparer if you're doing these kind of deals and understand how it's going to impact you there. But the other thing is sometimes people just have much different time preferences for their money, right? Some people value money now much stronger than money in the future than others, right? And that's why we use different discount rates when we're calculating these. What the correct discount rate um, is really up to the individual investors, but I think that there's some guidelines that you can use, and we're going to talk about that a little bit too. So, first of all, I just want to point out a couple of the places where I think this comes into play quite a bit. We're trying to sell Penhurst with owner financing. We've had both cash only deals and owner financing deals. And when I've looked at the math of it, sometimes I've wanted us to go with the owner financing, sometimes I've wanted us to go with the cash, and all the times we've just fumbled and lost the buyer so far. So it's something that there's a vote out to have Alec take over that process, and hopefully that goes through. Um, but in general, I think that uh, we're not good at structuring these deals in a way that, or countering sometimes in a way that can keep the buyer interested, but not just really give up the farm trying to make a deal happen. One other aside I just wanted to mention, there's this Mount Vernon property that has this huge uh, insurance payout. It seems like, just looking at some of the discussions people have had around this, that they're really ignoring the time value of money in this situation. They have this huge sum of cash, and they're going to have some future liabilities. But there's some people that are talking about, let's just hold on to all the cash until we know what the liabilities are, versus, we can get some very general idea about where things are going to end up, reserve and maybe double it, right? And maybe put twice as much as you think, but then send the rest of the cash out to the individual investors, and it'll be, that from a investment perspective, it'll be a much better deal for them. The people that are still holding those tokens. I actually sold out of mine already, so it doesn't really matter. But I just thought, seeing a discussion in there recently, some of the this points people made just made me really think that they don't think about money in those terms. And I being a classically trained finance guy, it is and someone who's worked in this field for 20 plus years now, it's really impossible for me to get my head out of that thought process. So whenever I see people saying things like this, like, oh, well, if we can just keep the cash there and, at least we're going to get put it in a bank account and get some return until we know everything is done. In certain instances, that level of conservatism might make sense. But if all you're doing is just dealing with what's left over as far as a burnt out building and demoing it, um, I would hope you're not trying to hold 90 something thousand dollars, which is what they received in a payout, right? But again, not my concern anymore. Somebody else is going to make those decisions, but hopefully when they're doing some math around, you know, paying that cash out earlier, versus holding it for a long period of time, will create a huge difference in the value of those tokens to somebody who bought them recently and going forward, or somebody who's considering buying them today, right? Because those tokens are still trading. Um, the one I'm going to do the math around, and sort of loosely modeled, is this 5401 ODM. This is one that we have listed on the market. We were trying to get 550,000 with a stated interest rate and a certain down payment, and we've had zero interest with the terms that we're looking at, but we've got one offer that is you know zero interest for. They're actually looking at 7 years. I'm going to do the math at five, just because. Yeah, I like to look at things at 5 years. I don't have a good reason. I didn't want to drag the math out too far, and it already looks horrible at five, so it will look even worse at seven. I'm also not doing it exactly. I set this up more as a generic example, but very loosely modeled it after this Odom deal. So, a $550,000 purchase price with a $50,000 down payment. That is one of the ways that we attract buyers when we're selling with owner financing. So I sell a lot of my own stuff with owner financing, or I have in the past. Um, Usually I'm asking for a very small down payment and a high interest rate. And, I'm trying to get the best deal for myself. But at the same time, what really attracts people that want to be on the other side of an owner finance sale is typically a small down payment and the smallest monthly payment possible. They're very often they're not concerned with the total that they're paying over time. And so I'll often structure an interest only deal with a balloon, or high interest rate, very long amortization. But so I'm getting a good return over time. They put very little down up front, but most of my deal, actually most of my return, comes from the high rate, and often it's because I bought the property, sold it immediately with the financing in through a premium in there. But one of the things that I actually benefit from by having a very high rate is that people tend to pay off or refinance my deals out earlier, and so I get the benefit of what I sort of get the benefit as if there were a balloon payment, because I do get paid off early, but it doesn't look so egregious when the other person's considering it up front. So that's sort of an aside. But so, okay, in this deal, right, we have, the down payment is barely covering the closing costs, and maybe in this situation the closing costs would be a little bit less. But this is the math that I did, right? I think I did a 8%, yeah, 8% closing costs. Yeah, I think we have a cheaper agent. We're saving about a point and a half relative to what I'm used to paying. Um, and there's also not a whole lot of closing costs involved when you're doing owner financing. So anyway, maybe that's a little bit high. We could do a little bit better, but there is also going to be prorated taxes and whatnot. So that's what I used. So at closing, what we would get if we sold this with these terms is $6,000 in cash and a note for $500,000. And so what I'm going to look at is a couple different scenarios where, okay, if we're charging 8% interest and it's interest only, versus 8% interest and we have a 30-year amortization, and then also looking at that at 5 and at 0. And I think to some people this is going to be surprising, I think. And I'm looking at, so what I'm doing, I'm setting up the cash flows here. And so Uh, and so the 6,000 I'm just adding directly to our net present value because you get that 6,000 instantly. And then from then on, I'm looking at, okay, what's the payment? And so I just, for the interest only, it's just really simple math. Well, I mean, I calculated them up here, right? But all it is the interest rate uh, times the unpaid principal balance. That's what UPB is. And then divided by 12. Well, actually, no, I'm just doing it annually, right? So this is just an annual rate. Um, and so, we're getting $40,000 in interest for 5 years. And then at the end of the fifth year, we also get um, $500,000, right? Because that's the unpaid balance on the note. If we discount that at an 8% rate, it turns into $506,000 because that's the 500,000 plus the 6,000 that we got at closing. Now, why am I picking an 8% interest rate? I've noticed some people are trying to use like a very low bond rate for this, right? There's people like, oh, I want to discount it at 4% or 5% to figure out the net present value. But if you're using those rates, that's like a safe rate, right? If you don't have any risk in the deal, then it makes perfect sense to do that. Well, that's not what this is, right? This is a relatively low down payment to somebody who is avoiding using a traditional bank for some reason. So this is a riskier deal, right? So you want to use a rate that is somewhat in line with private mortgage rates, right? And so that's why, if we and I that's why I think somewhere around 8 or 9% is a percentage rate that works perfectly well for that. You also want to think about, okay, if I had that money today, how much could I get if I invested it? And well, if you're an investor on Lofty, hopefully you could find a place to do better than 8%. But if I wanted to put it in mortgages, right? Like you could put it on in Arrived's private credit fund, and you're getting paid around 8%, I think is their stated rate on that. That's an investment in mortgages. You could do it in the Flywheel portfolio on ground floor. Again, that you do a little bit better. So maybe your discount rate should be a little higher than the 8%. Which before I forget, please like and subscribe. In the description to this video, I have links to all the other fractional real estate sites that I'm currently invested on. Please do all your own due diligence on the platforms that I mentioned and on the properties themselves. Just because I am or am not buying some of these doesn't mean that you should. Also, I've set up a Discord for us to discuss fractional real estate investing in general. So any of the platforms, any topics, not just like limited to the certain platform. So you can see that in the description of this video. There's a link to that as well. Um, okay, so again, if we're using an 8% interest rate with a 30-year amortization, it basically ends up being the same. The difference here has to do with the timing of receiving money back. I was actually surprised. It looks like the interest only does slightly better for you, but I think it's really just has to do with the timing because I'm doing this annually instead of uh, monthly, even though I calculated a monthly payment and then annualized it. So anyway, this is mostly rounding issues, right? I mean, it's very close. But you can see, right? Like in this situation, we're selling at 550,000, and we're essentially getting everything other than the closing costs back, and that's what it's worth to us. So I think that's a perfectly reasonable deal. We're getting, obviously the market said it's not, right? They think that 550 is too much. Um, you know, Maybe we either have to lower that price or we have to have much more flexible terms than what we had originally offered. Um, but okay, what happens if we drop our interest rate down to 5%? Well, all of a sudden, doing the same thing, right? Calculating the monthly payments, discounting everything back, you end up having, we lose $60,000 in value between these two interest only payments, right? In current terms, right? So by dropping, a lot of times we get into this discussion and we're like, oh, well, they're still giving us 550, and we kind of get fixated on that. A lot of people do, not realizing that, okay, moving the interest rate, oh, 3%, 5%, both of those seem pretty fair. 5% is better than I'm getting on my bank funds, right? Like these are the types of discussions that you start to hear. Um, But no, we're giving up $60,000 in net present value by doing that, right? Just by moving the interest rate 3%. by moving it another, by going to 0%, which is the offer that we had received, over just 5 years at 0%, interest only means no payments at all. And then the balloon, discounted at 8%, that's only $346,000. Uh, what I think they actually proposed was making amortizing payments and then paying the rest in a balloon. And, that's still 356,000. And actually what I did here is only go to 5 years. If we did it to seven, it's gonna look even worse. I don't know. This is very much. I just think that seven is preposterous, and I thought I always like to do 5 year stuff like this. That's a lot of my deals are that. So I already had some little tables set up. Um, anyway, but and I think so that really shows you the difference, how much difference that interest rate can work in actual value to you, right? So using a 0% interest rate in a 30-year AM, you're losing $150,000 in value versus an 8% rate, right? And so, or versus, if we just got cash today at the 550, right? If we got 550 today, we'd end up with $506,000. And with a at 0% interest over 5 years, well, the actual value to us is going to be 356,000 today. So it's $150,000 less in value, and that's if you're happy with an 8% discount rate. I think it's a fairly common rate to use. When I sold notes in the past and whatnot, because that's one of the other things too is we could sell it, have the note, and then go try to sell the note to a note buyer. And this is the math they're going to do. And actually, I think it's a little more complex. The math I think most of them will do is they'll do a net present value on the payment streams, on the monthly payments separate from the net present value on the payment that you get at the balloon. A big part of why they do that is because often private loans, they have a hard time refinancing them out. They want to extend it further. And so there's a lot less certainty in the value of that balloon payment. And so like a pretty common setup I've seen is where you might have 8% discount rate on your monthly payments, but then a 10% discount rate on the balloon. If we do that, where you saw, where you saw the value, and this would be, should we look at it this way and actually think that we're getting significantly less value? Maybe. But it's definitely how, if we go to try to sell that note, I believe they'll look at it like this, or at least some note buyers will. They might not all. Some of them might just apply a discount rate to the whole payment stream, but many will put a different amount on the monthly payments than they will on the balloon payment. And so you can see, again, for the interest only or the 30-year AM at the 8%, these end up being very similar, because we're doing the same thing, and it's not a huge difference. Actually, that seems way too close to me. I kind of wonder if my math is a little screwed up here, because these two, hmm, well, that just worked out really funny, so that those would be so close, because we have a much different UPB. Oh, but we're getting that cash back earlier, so I guess that kind of makes sense. Sometimes when I switch back and forth between, I mean, you could tell most of this math, you can't do it in your head, right? And most of it starts to feel, you can start to get a feeling about, okay, does this look right or not? But sometimes when I'm switching between amortized and interest only, and then I'm doing net present values, um, it doesn't feel intuitive, even though I've done this for a very long time. And so that's why sometimes you just have to, well, you always have to just actually do the math and then figure out, okay, what am I missing here? Oh wait, do we have the plus six? And we have it in both of those. Okay. Anyway, very similar there. But again, like once we switch to to 5%, we're getting just losing a ton of value by doing it. And then when we go to zero, right? Like, I mean, then our total value, yeah, I mean, we're doing a little bit better, because we're getting these payments up front, right? And so we're only discounting this last balloon here. So we do significantly better, I guess, 15,000 better with the amortizing payment between these two. But we're still just grossly underperforming, like One of the things to think about is on Odom, we do have a cash offer, or we had one recently. Nobody was happy with it. But to take, the 550 with 0% interest, we're actually, the value to us is significantly lower than what we were going to net with that cash offer. And so I think that that's where things sort of fall apart for people is they'd much rather have that 550 purchase price because then they don't feel like they're losing money. But if I'm getting 550, but I'm getting it, $500,000 is coming 7 years from now, or in this math's case, 5 years from now, that's really only like getting 310,000 or 316,000 today. Um, it's significantly worse, right? Than, or, even in this situation, like 340, 350, like it's significantly worse than if we just took a cash offer, right? Because, um, uh, you know, but people do this sort of thing all the time. It makes their ego feel better, right? If they never run the math, they're like, I didn't lose money. We bought it at 550. We sold it at 550. We broke even. Sure, I got payments over time. But if you're really being honest with yourself and you're doing the math and you understand that no, there's an opportunity cost to waiting 5 years to get that money, right? I could very easily put it in something, expect to get 8%. So I think an 8%, discount rate makes perfect sense. Um, because I can, I'll put it in something with very similar risk to what this transaction is, right? Private mortgage, whatever that is. And so that's why whenever we're getting these offers and counter offers, I got pretty worried on this one when we got that, full price but 0% interest offer that people were going to take it. I was pretty glad that we didn't, and then we provided a counter. But then they countered back and again wanting 0% interest, but just with a shorter timeline. And I think that there's a real danger. I'm going to really think twice about who the other owners are in some of these properties with me before proposing that we do owner finance deals in the future, because some of the discussions around the value here really worried me. Um, because it is. I mean, like there's almost, could we do a year or a 2 year zero interest? I mean, we could, but that's really like giving up 8% of the value or 16 or, but and then the further out you go, you really start to compound that. Um, so it's really important whenever we're looking at these deals to kind of not get lazy, actually put the values in a spreadsheet, figure out what's that discount rate worth to me. Um, because it's pretty scary to see people talk about it in a way that it's like, oh, well, it's a full price offer, so we're not losing money, and who cares if we're getting those payments over 5 or 7 years? I'd rather start getting those payments now. All this, and this is sort of when I'm selling with owner financing and getting really great deals, it's because the people on the other side are kind of thinking in the same way. They're, well, or actually they are thinking in the opposite way, right? Like, oh, it's a payment I can really afford. It doesn't, they're not really thinking about the full amount. And so, I've been really on both sides of these types of transactions and seen the danger of the benefit to one party and the danger to the other of really ignoring the math of the situation and just anchoring on either the price or the payment or any number of things. And so that's one of the reasons that I really like doing interest only deals. um, is because, like, you can see here, like, their actual net present value with the amortizing and the interest only is about the same, as long as the rate I'm getting is very similar to what my discount rate is going to be, right? And so I'd almost always prefer to sell with an interest only payment, because depending on what's happening with my taxes and the gain on that property. But the big reason being that um, having that lower payment is easier for my buyer. And so then they can stretch a little more and pay a little bit higher, right? Like, I mean, in this scenario, you could imagine I could charge a 9% interest rate interest only or an 8% interest rate amortizing. A lot of times when I'm putting those deals out, I just say, you know, X% interest, X is your monthly payment. I don't really say, it's not clear, or I'm not, saying exactly what it is until we actually get into the deal. But right from an advertising standpoint, the first thing somebody sees is, oh, what's that payment? Can I afford that payment? And then we can get into the details of, yes, that's an interest only payment. And then we have a balloon. Um, I never want someone to sign up for, uh, to sell with a payment that they're not going to be able to make it, right? I want to make sure that's affordable too. And the interest only allows that as well, right? It keeps a lower payment relative to, if you're amortizing with the same rate and the same unpaid balance. That's really all I wanted to cover. I wanted to make sure this is something, and I don't know if this is something that I should take like more time and dig into the math of it, or if this is, pretty obvious to people or not. One of the things that terrifies me is I've seen a lot of people just using Chat GPT or Grok or someone to, run their numbers, and it's obviously perfect. I am very impressed with AI. I'm not telling you that it can't run numbers, but I've seen oftentimes if it misses something, the person who's using it as a way to do it doesn't understand the numbers well enough to realize that there's important things missing, right? That's why I always would encourage you, put your own little calculator together in Excel, actually figure out, what's the amortization, and you can see down here, I actually put together an amortization schedule with the payments and the interest and the principal. This is how I figured out what the unpaid balance would be of each of them at different timelines. It's just something that if you're going to be in this business, you're going to invest in these types of deals and be involved with structuring the sales with owner finance or purchases with owner finance, uh, it's really a necessity, right? Because if you try to just use like these different online calculators, you'll never really know exactly what the calculation looks like. And so it's really easy to, one, just use the calculator wrong, right? You're putting in inputs that are not actually what's intended for. And I see people do that a lot. But then the other is I just, I know plenty of people who just are like, ask Chat GPT, okay, tell me what the net present value of this deal is. And maybe they don't give it all of the inputs that they should, right? And if you're running your own calculations, you'll realize that you did left something out. If you're talking to AI, it doesn't, sometimes it will just fill something in for that. Or it will, that's one of the things that I've seen people do quite a bit is just have like sort of oversimplified calculations and not realize that they do. And it's because they didn't give, whatever they're using enough information. But if you're plugging in everything that yourself, um, hopefully it becomes a lot more clear. So anyway, that's really it for me for today. If this is a topic you'd like to talk more about, feel free to jump in the Discord or put some comments below. Um, or just let me know. Some of you, a lot of you now are just DMing me through Discord. You're welcome to do that. Some of you found me on X and a couple people through Facebook. Any of the places you want to talk to me, I'm happy to do it. This is the kind of stuff that I get really into because I think it's a place where we can create a lot of value for ourselves by putting together transactions that, maybe it is providing a very low entry point for somebody else to buy a low monthly payment, but also still getting a very good deal for ourselves. Um, in any case, I think that's it. And so until next time, I'm going to keep doing nerdy math stuff so that you don't have to, but actually you should. So I'm just going to keep making mistakes so that you don't have to.